Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Foreign Exchange Risk. Foreign exchange risk, also known as currency risk, arises from the potential for an investor's or a company's cash flows, assets, and liabilities to be affected by fluctuations in exchange rates. This type of risk is particularly pertinent in the context of globalized markets, where businesses and investors frequently engage in transactions involving multiple currencies. Foreign exchange risk can significantly impact the profitability and stability of firms operating in the international arena, making it a crucial focus within the broader scope of market risk management. One fundamental reason why foreign exchange risk is critical in market risk management is its pervasive nature. Companies engaging in international trade, investment, or financing are exposed to exchange rate fluctuations that can lead to unpredictable financial outcomes. For instance, a US-based company exporting goods to Europe and receiving payments in euros would face the risk that the euro might depreciate against the US dollar, reducing the value of its revenue when converted back to dollars. Conversely, an appreciation of the euro would enhance the revenue's dollar value. This inherent volatility necessitates a strategic approach to managing foreign exchange risk to safeguard financial performance and stability. Foreign exchange risk can be categorized into three main types: transaction risk, translation risk, and economic risk. Transaction risk is associated with the potential for exchange rate movements to affect the value of future cash flows from specific transactions. For example, if a company agrees to purchase goods from a foreign supplier with payment due in the supplier's currency at a future date, any adverse exchange rate movement could increase the cost of those goods in the company's home currency. Translation risk, on the other hand, arises from the need to convert the financial statements of foreign subsidiaries into the parent company's reporting currency. This is particularly relevant for multinational corporations with operations in various countries. For instance, a U.S. multinational with a subsidiary in Japan must convert the subsidiary's financial results from yen to dollars. Fluctuations in the yen-dollar exchange rate can distort the parent company's consolidated financial statements, affecting reported earnings and equity. Economic risk, also known as operating exposure, reflects the broader impact of exchange rate movements on a company's market value and competitive position. This risk is more challenging to quantify and manage as it encompasses the long-term effects of exchange rate changes on a company's revenues, costs, and market share. For instance, a U.S. manufacturer competing with European firms might find its products becoming relatively more expensive if the dollar strengthens against the euro, potentially losing market share to European competitors. To mitigate foreign exchange risk, companies and investors employ various strategies and financial instruments. One commonly used approach is hedging, which involves taking offsetting positions in financial instruments to protect against adverse exchange rate movements. For example, a company expecting to receive payments in a foreign currency might enter into a forward contract to lock in the exchange rate at which it will convert those payments into its home currency. By doing so, the company can eliminate the uncertainty associated with future exchange rate fluctuations. Another hedging instrument is the option contract, which provides the right, but not the obligation, to buy or sell a currency at a predetermined exchange rate on or before a specified date. Options are particularly useful for managing asymmetric risks, where a company wants to protect against unfavorable movements without foregoing the potential benefits of favorable ones. For instance, an exporter might purchase a put option to sell a foreign currency if it depreciates, while still retaining the ability to benefit if the currency appreciates. In addition to financial hedging, companies can adopt operational strategies to manage foreign exchange risk. One such strategy is natural hedging, which involves aligning cash inflows and outflows in the same currency. For example, a multinational corporation with revenues and expenses in euros might establish a euro-denominated bank account to match its euro cash flows, thereby reducing its exposure to exchange rate fluctuations. Diversifying operations and supply chains across multiple currencies can also help mitigate foreign exchange risk by spreading exposure across different currency pairs. Empirical evidence underscores the significance of managing foreign exchange risk effectively. According to a study by Bartram, Brown, and Minton, firms that actively manage their currency risk through hedging tend to exhibit lower cash flow volatility and higher firm value compared to those that do not. This finding highlights the tangible benefits of currency risk management in enhancing financial stability and shareholder value. Moreover, historical examples illustrate the impact of foreign exchange risk on businesses. During the 2008 financial crisis, several multinational corporations reported significant losses due to adverse exchange rate movements. For instance, General Motors faced substantial foreign exchange losses as the US dollar appreciated sharply against other currencies, exacerbating the company's financial woes during an already challenging period. Such instances underscore the critical importance of robust foreign exchange risk management practices in safeguarding corporate financial health. Furthermore, statistical data from the Bank for International Settlements reveals the growing significance of foreign exchange markets in the global financial system. As of April 2019, the average daily turnover in global foreign exchange markets reached $6.6 trillion, reflecting a 29% increase from 3 years earlier. This remarkable growth underscores the heightened exposure of businesses and investors to currency risk, amplifying the need for effective risk management strategies. In the context of the Associate Professional Risk Manager certification, a deep understanding of foreign exchange risk is essential for professionals tasked with managing market risks. The APRM curriculum emphasizes the importance of identifying, measuring, and mitigating various forms of market risk, including currency risk, to ensure the financial resilience and stability of organizations. By mastering foreign exchange risk management, APRM candidates can enhance their ability to navigate the complexities of global markets and contribute to the overall risk management framework of their organizations. In conclusion, foreign exchange risk is a critical component of market risk management, with far-reaching implications for businesses and investors operating in the global marketplace. The inherent volatility and unpredictability of exchange rate movements necessitate strategic approaches to mitigate potential adverse impacts on financial performance and stability. Through a combination of financial hedging instruments and operational strategies, companies can effectively manage their currency risk and safeguard their market position. Empirical evidence and historical examples underscore the tangible benefits of robust foreign exchange risk management practices, highlighting their importance in enhancing financial resilience and shareholder value. As the global foreign exchange market continues to grow, the ability to navigate currency risk will remain a vital skill for risk management professionals, including those pursuing the Associate Professional Risk Manager certification. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.